In recent days, the U.S. stock market has continued to weaken. In the past week, Microsoft stock prices fell -3.5%, with Apple -6.6%, Google -3.2%, Facebook -1.5%, Amazon 4.8% and Tesla -13.5%. Growth stocks, which had risen significantly until the past, were particularly weak. On the other hand, financial stocks, energy stocks, and healthcare stocks have declined slightly or have risen. Many analysts say that the biggest reason for such a sharp decline in growth stocks is the rising interest rate on U.S. 10-year Treasury bonds. As you can see, the U.S. 10-year Treasury rate has risen sharply, surpassing 1.51% on Wednesday, February 24. After that, it showed calm and ended at 1.39% on Friday, February 26. If bond rates rise like this, there is a fear that money will be pulled out of the stock market, and above all, the Fed's tapering could begin. In particular, this is the reason why growth stocks more affected by these interest rates fell. So, inflation has begun, and will it proceed as markets concerns? I have two questions. The first question: is inflation started? The market is confused because it does not know what the change in the investment environment will be due to inflation. So, it showed a panic sell for bonds, which caused stock prices, especially growth stocks, to plummet. The Fed replied, "Inflation has not started yet." After the Fed said this, the rate of 10-year U.S. Treasury bonds, which had risen sharply, began to fall. If the stock market believes and follows the Fed's words, the stock market will stop crashing and rise again next week. But otherwise, if the 10-year bond rate exceeds 1.5% and continues to rise towards 2%, the stock market will continue to weaken. The thing to note here is that the Fed is hoping for inflation. We have been living without inflation for the past 30 years. This was led by an increase in productivity due to the development of IT technology and cheap daily necessities due to China as a global factory. The Fed believes that inflation is the condition that can softly stop emergency measures for the economy through quantitative easing. Firms' investment and production increase through inflation, resulting in a stable job market and a healthy economy. This is because the Fed can then stop quantitative easing and start tapering and bring the economy back to normal without the market being surprised. The Fed believes it is not inflation right now, and on the other hand, it is hoping that moderate inflation should come and that the economy will be healthy. So what should we do when inflation actually comes? When inflation comes, the value of cash falls. When the price of goods rises, it means that the value of cash falls. This means that if you have cash, you will lose money. You have to invest your cash elsewhere to avoid losing money. As the price of goods rises, you have to invest in the goods or the companies that make them. In other words, investment will be concentrated in the stock market or the real estate market. The stock market is now confused because it cannot accurately predict the changes in the investment environment that inflation will bring, so stock prices, especially growth stocks, have plummeted. This is because the nature of inflation is unclear. The Fed said inflation has not started now. If the market accepts this, the current collapse will subside in the short term. However, since inflation is bound to come, there is a high possibility that this confusion will occur again. Even then, the role of the Fed is important. The stock market will respond positively if the Fed demonstrates its ability to properly manage inflation. However, if there is confusion caused by rapid inflation and the Fed's ability to manage is questioned, the market will become very unstable. The bottom line is that over the past few weeks, interest rates on 10-year Treasury bonds have risen due to inflation concerns and a collapse in growth stocks. This is likely to settle from next week with the Fed's remarks that it is not inflation. In the long run, inflation is inevitable, and in order to avoid such confusion, the Fed must succeed in demonstrating its ability to manage inflation. Inflation itself means the economy is healthy and will increase investment in the stock market. However, rapid inflation beyond the control of the Fed can lead to confusion by increasing uncertainty about the investment environment. Investors should take this perspective and look at the future market.